that your net worth completely explodes after your first 100K.
$100,000 is hard, and I mean capital H-A-R-D hard.
And it all starts with that first $100,000.
Why does your net worth explode at 100K?
Charlie Munger famously said, the first 100K is tough, but you've got to do it. Well, he actually said the B word, but in fear of demonetization, I won't say that in the opening line. When he died back in 2023, he had a net worth of 2.6 billion, so he clearly knew his shiz. Oops, nearly said it. This statement underscores an essential truth in personal finance. Building wealth is unfairly difficult at the beginning, but once you build a good base, momentum begins to work in your favour. In this guide, we'll explore why saving the first 100K is so difficult, but why it's so essential that you need to do it. In addition to this, I'll also share some ideas to help you save it even faster. So first, let's jump into why the first 100K is so challenging. When starting from scratch, the process of accumulating wealth can feel frustratingly slow. Believe me, so many times in the past, I'd save 1K, thinking I was doing everything right, but I quickly got bored by the slow growth. In light of this boredom and lack of motivation, when my friends would ask me if I want to go skiing, I'd turn around and go, yes, F it, let's do it. And although I had a fantastic time, I'd have to restart from zero every time, which has held me back for years, I'll be completely honest. With limited capital, the returns on your investments are modest, and much of your progress comes from diligently saving rather than through that compounding growth. For example, if you save 5K annually and earn a 7% return, you will accumulate approximately 29K after 5 years. And this is an impressive amount, but you're still miles off that 100K mark. And add to the financial pressures of rent, student loans, friends nagging you to go skiing, and day-to-day living expenses, especially in a cost of living crisis, it's clear to see why reaching that 100K milestone is so hard for so many people to achieve. Yet, this early stage is critical. The first 100K sets the foundation for long-term exponential growth. Let's dive into the principles behind this. Core principle number 1 is the power of compounding. Compounding is the principle that allows wealth to grow for you exponentially over time. It's a process of earning returns not just on your initial investment, but also on the returns that the investment generates. And whilst the effects of compounding are modest at first, they become increasingly powerful as the base amount of your capital grows. So consider this example to demonstrate this. If you have 1K with a 10% return, in your first year you will earn $100, bringing your total to 1.1K. In the second year, you earn a further 10% on the 1,100, resulting in 1,210. After 10 years, your original 1K grows to approximately 2.59K, which is okay, but personally doesn't excite me. Now, imagine you're starting with 100K at the same 10% return. Your investment grows to 259K over the same period, a far more exciting sum. This is why reaching 100K as quickly as possible is critical. The larger your starting capital, the more impactful compounding becomes over time. Core principle number 2 is the momentum in wealth building. The first 100K is the hardest to accumulate, but momentum accelerates as your capital grows. Let's dive into an example to illustrate this. If you were to save $500 a month, with a 10.13% return, which by the way is the long-term growth rate of the S&P 500. It would take you just under 10 years to save your first 100K, and most of that growth comes from your contributions rather than compounding, with 60K coming from what you've invested and 40K coming from compounding. To double your money to a 200K, it only takes a further 4.5 years though, with 120K coming from compounding. To save another 100K, it only takes an additional 2 and a bit years, and so on. As you can see, the more money you have working for you, the faster your wealth grows. By the way, investing $500 a month for 29 years would earn you over $1 million, with 880K coming from compounding growth. To contribute this point, let's jump into the role of savings versus investment returns. In the early stages of wealth building, most of your progress comes from savings rather than investment returns, which is extremely frustrating, I know. And whilst optimizing your investments is so important, the most impactful factor in reaching your first 100K is how much you save and how consistently you're able to do it. Now we understand all of this, let's discuss a few strategies to reach that 100K mark even faster. And I'm not gonna lie, it isn't easy, but you can do it. The first thing to do is to increase your income. Boosting your income is one of the most effective ways to build your wealth faster. Whether through negotiating a raise, finding a higher paying job, or even starting a side hustle, increasing your earnings potential can significantly shorten the time it takes you to reach that 100k mark. One piece of advice that I always give to my friends and the young adults I mentor is to try and learn an in-demand skill, something that pays a lot of money, such as procurement, finance, project management, cybersecurity, etc., as having one of these in-demand skills can help you to significantly increase your earnings potential. On this basis, I'd also recommend trying to focus on a skill that can't be replaced by AI. So I'd say anything that's relationship based is probably going to stay around in the mid to long term. In addition to increasing your core income, you could consider freelancing, getting a part-time job, or even starting a side hustle. The more you earn, the quicker it's going to be to build that first 100k, something that we need to do ASAP. The next thing to do is to reduce and manage your expenses. Whilst increasing your income is crucial, managing your expenses is equally important. Living below your means allows you to save a high percentage of your income, which is critical in the early stages of wealth building. Now, I'm not advocating that all you do is save and don't enjoy life. In fact, in a recent video, I discussed how by capping your expenses at 60%, you can save enough money for investing and enjoying your life at the same time. If you'd like to see this video, I'll link it for you at the end. The next thing to do is to keep as much of your money away from the taxman as possible, and this is legally, of course. Tax advantage accounts like the 401ks, the IRAs in the US, and the ISAs in the UK are powerful tools for building wealth, because they reduce your tax burden and allow your investments to grow efficiently without paying loads of tax on these. If you're not already using these, please research these. Personally, I try to keep most of my investments in a tax wrapper account such as the stocks and shares ISA in the UK. Now you've done this, you also want to make sure saving money is as easy as possible for you, as if you don't do this, you probably won't do it. Automation is a simple and effective way to ensure that you consistently save. By setting up automatic transfers to a saving or investments account, you remove the temptation to spend money before saving it. Honestly, this is really powerful. Automation is fantastic as it creates a system that prioritizes saving without constant decision making. Now, you should also try to optimize your investments. While saving plays a large role early on, investing wisely is essential for maximizing your progress. Choosing investments that balance risk and return ensures that your money grows steadily over time. Although the market is absolutely booming right now, try not to fall for that hype and invest all of your money in risky assets, as although you might be lucky and make a fortune, research shows us that most retail investors lose a lot of money when chasing speculative assets. Instead, diversify your portfolio, look to invest in a mix of assets such as index funds, ETFs, and bonds to spread your risk. Also, you need to ensure that you use low-cost investment options or brokers, as high fees can eat into your returns. So opt for low-cost funds with expense ratios under 0.2%, for example. Finally, you need to stay consistent. Invest regularly, even in market upturns and downturns. By doing this, you can minimize your risk and ensure that you're buying more stocks when the price is low and less stocks when the price is high. By adopting a long-term investment strategy, you can avoid costly mistakes and maximize your growth. I personally lost 30k investing in meme stocks back in 2021, and honestly, I've got the war wounds from that, and I've really made this channel just to help people learn from my mistakes. If you're holding cash for short-term goals and or your emergency fund, consider moving it into a high yield savings account. These accounts offer significantly higher interest rates than most traditional bank accounts, helping your savings to grow with minimal risk. Just please make sure if you're moving your emergency fund into one of these high yield savings accounts that the cash is easily accessible and you can get it out in terms of emergency. As an example, Trading 212 is currently paying 5.1% per annum, and that's interest that's accruing daily. Finally, reaching 100k is more than a financial milestone. It is a psychological shift. Seeing your capital generate meaningful returns builds confidence and reinforces good financial habits. Additionally, having 100k provides a sense of security and opens up opportunities such as investing in real estate or starting a business. This is where you can earn a lot more money also. Remember, the journey to your first 100k is challenging, but it's critical. By increasing your income, managing your expenses, and leveraging the power of compounding, you can accelerate your progress towards this milestone. The hardest part is building momentum, but once you achieve 10k, 100k, 200k, etc., the process becomes significantly easier. As mentioned earlier in the video, watch this video here to understand how you can still enjoy life whilst building for your future by copying the money strategies of the financial elite. Charlie Munger's advice remains as relevant as ever. The first 100k is a bitch, but you've got to do it. Dumb. I said that word. It was going so well.